equities against volatilities. And this tells us that they are dropping volatility more than prices rising, which suggests that they must be really, really bullish. Really bullish. So what happens if we see some of these elements developing? What happens if we see the price dropping and we see volatilities rising? Well, nothing much happens. It depends how much it rises. It's probably going to rise, but how much does it rise? Well, what happens if it rises all the way up to here? Then you start saying to yourself, well, this is going to start showing the possibility that this market's reversing out a little bit. What happens if equities then rise? What happens if equities then rise here? And volatilities don't move, hardly move at all. Well, we know what that means. We know what that means, don't we? We're going to start seeing something like this. What you're going to be starting to look at is the possibility that that's now going into possibly a sell reversal. Simple, easy to see indicators, which highlights something quite sensational. If I look at it from an individual perspective, all the big days, all the big points of the day are very, very clear to see. Take a look at yesterday's close. This is yesterday's close. Look at what they were doing to volatilities against equities. Amazing, isn't it? That this is so obvious that this is going to be a very substantial sell-off. Why? Well, for that orange line to be dropping, just like we drew, volatilities must be at elevated levels. Even though equities are high, volatilities must be at elevated levels against equities. Why would that ever happen? It's not historical volatility we're looking at, guys. It's priced volatility. It's the same as the specialists. It's another way of looking at the specialists themselves about their pricing mechanisms. And then all of a sudden you go, wait a second, that means the market's going to gap down tomorrow by the looks of it. No shit, Sherlock. So when we look at that there, we're thinking this is going to gap down tomorrow. The market gapped down the very next day. Unbelievable, I hear you say. Damn tootin' right, it's a response to that, right? Because it's a great trade. Now we see the divergence at the open down here. We see that exact same opposite reversal coming in here. The divergence is visible. You can taste the divergence in the markets here. And you can start to recognize the opportunity and maybe swing back some buys into this trade here. Swing back into some buys here. Boom, straight up, right? Straight up like a crazy. Pull back here, massive divergence against the pricing of volatilities. They're not worried. If they were worried, they would have priced up their volatilities accordingly. They're not worried. So that's an opportunity for you to buy into some equities there. When they're not worried, there's a better opportunity. Boom, straight up she goes. As we move up into this little change of behavior, remember it's still pricing up this big shift to the upside. So this is still bullish. So you've got to be aware of that. Now that we're starting to get into that extra leg higher, you're starting to think to yourself, okay. And what happens? Sell off on the short term, sell off on the macro. It's a possible sell. Divergence, possible buy. What about this face? Take a look at this in hindsight and tell me what you see. Look at the difference in opinion on the pricing of this higher print. Look at the difference in the pricing of this higher print, guys. It's amazing, isn't it? The higher print, and yet we're getting higher volatilities. What do you think is going to happen during this period? Do you think we should be selling it perhaps? Well, sure enough, we get that enormous sell-off in the US afternoon session. Simple, easy to see trades, isn't it? Simple, easy to see trades. Making sense of the obvious that's in front of your very noses leads to some incredible profits, guys. We'll be looking at that this afternoon as we get into the US Open. US Open now, guys, in just 13 minutes to US Open.